What is going on, guys? This is the Working Investor. In this video, you guys are probably going to be wondering what the heck is going on with this Working Investor. He was pumping EGGS, EGGY, and blocks, and now he is selling everything. Is this guy a grifter? Does he have some kind of pump and dump operation? Because I was just making not one, but a follow-up video on blocks. And I made a follow-up video on EGGS, EGGY, and what I didn't like about them, so they kind of have a hint why I don't like it. So in this video, I'm going to show you why I do not like this for myself. Part of it is the return, and part of it is because I have a better stack to put it into because I have diversified myself into multi-asset allocation, and I'm looking for returns with better compound annual growth rates and better Sharpe-Sertino ratio than the former. As always, nothing here is financial, tax, legal advice, or retail donkey advice. This is purely for fun and entertainment purposes only. Please see all my disclaimers. Let's get into the video. Let's go ahead and break it down. Numero uno, the number one reason why I had dumped blocks was because I had an allocation problem. An allocation problem. Just because something pays a dividend doesn't mean too much of a good thing could be a good thing. I had about 15-16% exposure to Bitcoin, and actually later on finding out that my notional exposure, because blocks, BLOX, has Bitcoin miners inside, and that gave me about 25% notional exposure to Bitcoin. That is too much exposure. I'm showing you this boring page over here because you can Google it or go on Chat or Grok or whatever, Gemini, and you can look up multiple sources. What is the optimal allocation? This is not financial advice, but I am using the advice that I am learning from people that I talk to, smart people, and I backed it up with my research, and the research shows that about this argument up to 5%, ish is optimal. Like, everybody's different. Some people like to have 99% Bitcoin, but I try to keep it around 5%. So by getting rid of blocks, I had my allocation problem fixed, and I got my exposure down to 6%. So at least it's closer to 5%. Let's talk about blocks for a second. I am not ingenuous in any way. I do generally like the way they do this strategy. It took me a lot of internal wrestling to dump this position. Now you can see here they have their Bitcoin and Ethereum exposure, hence its crypto exposure, cryptocurrency. And Ethereum is like almost 3 times the vol, if not more, than Bitcoin. So there's a lot of beta, a lot of volatility inside. So you have to know this is almost like a leveraged product. And also crypto industry companies, that also has a tremendous amount of volatility. Let's look a little bit into the companies that it holds. So you can see here, this is their top holdings. And again, I'm not saying this is good nor bad. I'm just saying it's not good for me. Doesn't mean it's not good for you or bad for you. You need to make that decision. But you can see here, there's a lot of Bitcoin miners. There's also high beta companies like Robinhood. There's NVIDIA as well, and there's Taiwan Semiconductor. So we're going into Bitcoin, a little bit of AI, semiconductors, kind of tilt, a little bit of fintech, which is Robinhood. Just like in gold miners and silver miners are more volatile than gold and silver, so are crypto or Bitcoin miners. They're more volatile than crypto. Did you know there is actually an ETF called WGMI? That is an ETF that tracks the Bitcoin miners. And if you go on the 6-month chart and you compare blocks to WGMI, you could see that WGMI, you can use a lot less capital and still have that exposure, that beta exposure to the crypto and mining with WGMI. It's almost like a leveraged product of blocks. But because one could get the same, a similar return with a fraction of the price to put in, you could have less money total exposed. But again, not financial advice. But again, the point is that I had too much exposure to Bitcoin. That's why I got rid of it. Let's move along to Nest Yield and their EGGY and EGGS products. And by the way, I've been reaching out to the management team, And I've been getting the runaround back and forth, trying to make a meeting. Then they switched it over to a Zoom call, but then I couldn't do the Zoom call. Then they said the number was okay. Then I called the number several times. They didn't pick up. And then they gave me another number. So I just got tired of chasing after and getting this whole runaround. My time is precious, and I just dumped all the shares. Let me show you why I dumped this. And I made a video explaining all this. So in the past month, EGGY and EGGS are supposed to give you, they pick their own underlyings, and it's typically in the NASDAQ realm and tech. And they do have MSTR. So there you go. You got more exposure to Bitcoin, right? Through MSTR. That's all I need is more exposure. So much exposure coming out of every pore of my cells. And you can see in the past month, they're supposed to have protective puts to protect you on the downside. And while the NASDAQ is down 1.35%, that's not too much to make somebody want to vomit in their mouth. They're down. EGGS is specifically, the reason why I'm pointing out EGGS is because not only do they have protective puts, that they're using money from your proceeds for protective puts, that increases the cost to carry. That makes it more expensive to have this underlying. And the whole point of these protective puts is to protect your downside, which it did not do. Also, they're supposed to have a tactical defensive tilt, like they had Costco and Walmart. And nonetheless, these things sucked. These things are down multiple times, 4x, whatever the NASDAQ is down, greater than 4x in the past month. I was looking back during the liberation period when they had a little bit of relative strength, but that doesn't seem like it's the case anymore. I did look over their holdings, and I'm not sure if I saw protective puts on the NASDAQ on EGGS recently. That would be a good question to ask the managers why they don't have them, or maybe I'm missing it when I looked at the holdings. But I did not see it. I looked at it several times. So let's talk about what is the genius reallocation of my investments that I did by getting rid of these high beta crap ETFs that are overexposed. So my objective is I'm trying to replicate the beta, but I'm also trying to hedge myself on many market cycles. I'm trying to create an all-weather type of portfolio. Some variation of it. Some call it the permanent portfolio, the golden butterfly portfolio, the Ray Dalio portfolio. The point is that I'm not just going to be exposed to stocks. I'm also going to have bonds, cash equivalents, but I wanted to beat cash and beat the rate of inflation to protect it, and a lot of gold. People who are very short-sighted only look at equities, and they only think that equities is the only way to make money. They forget that over many, many years in the market, there was something called the lost decade, where equities lagged, and it took about 10 years to break even. And if you had a portfolio that had a lot of gold and bonds and other type of assets that are non-correlated to equities, that would have saved you. But so the idea is that I want to have the exposure of equities. I don't want to have that FOMO, fear of missing out. So if there's a capture of beta in the market, I want to capture it. So if you look over here, 20% is TQQQ, which is triple leverage NASDAQ. The Qs basically represent a big momentum of AI and a little also kind of a momentum of risk on and liquidity. I feel like Bitcoin represents liquidity and basically people who have disposable income, because it's kind of like a little bit of a Ponzi scheme in a way. I'm sorry for the crypto bros, but you have to, give credit that it's being institutionalized madness, and there is some kind of use case for growth. So if you want that beta, I feel like I'm in the Qs. I do have that exposure. So because I'm capital efficient, I'm able to make more space in the portfolio to capture other assets that are non-correlated to the market. And it gives me hedges, it gives me alpha. So the next 20% was UGL. UGL is 2x leverage gold. Now, if you think about it, if I have 3x leverage times 20%, that's 60% NASDAQ exposure, and 2x leverage times 20% is 40% gold. So I have like a 60-40 portfolio, but instead of your classical 60-40 bonds and S&P 500 or broad market, I have 60% NASDAQ, which is high beta, and I have 40% gold. You're probably going to ask me what's going on, because 60% is still not 100% replication of your beta. You need a little bit more beta. So I have CGDV, which I made a video on. This is the Capital Group Dividend Value ETF. And they really try to exceed the S&P 500, and they focus on companies that pay dividends and have the potential to have the potential to do so. And I have 10% position in FLSP. What on earth is FLSP? That's the Franklin Systemic Style Premium ETF. Now, I probably just confused you even further, because what on earth is Systemic Style Premium ETF? That's just a lot of lingo to confuse people. So basically, it's a long-short strategy, and they look at 4 different styles. They look at quality, value, momentum, and carry. If you want, I can make a video on this and do a deep dive on this type of ETF. You can see it's a 4-star rating. Let's look at the chart and see how this thing does in down market. So if you go on the 1-year chart, you can see FLSP delivered 13.74%. The S&P 14.62%. So you're going to wonder, a dumb person's going to say, oh, you're such an idiot. Why are you investing in FLSP? You should be chasing the highest yield possible. That is what a dumb person will ask. What a smart person would ask is, look at the risk-adjusted return. Look at the chart. Look at the path. How did this thing get to 13.74%? Do you notice something interesting? When the market took a complete dumpster dive, this thing only dived a little bit. This is very low vol to the bottom, as you can see. Past performance is not indicative of future gains. But this thing is a rock in the portfolio, relatively speaking, to the Qs, which is all zig and zaggy, especially if I have TQQQ. But to something that's so stable, to almost give you the performance of the S&P 500, this is amazing, because when the market is crashing, you're going to be happy. You're probably going to be happy having this one. Again, not financial advice. CGDV. CGDV, remember they said that they're trying to give you a value tilt, but they're trying to beat the S&P. Now, did they beat the S&P? Yes, they did. They delivered you 20.16% in total return, and they outperformed the S&P 500, and this is not bad for a value tilt. By the way, I did look at the holdings of CGDV, and they do have NVIDIA as one of their highest holdings, so that could be part of their secret sauce. Let's go down the list. So you can see here, we're up to RSBA, and I mentioned it in one of my previous videos. I call it a RISBA, and that's stacked bonds and merger arbitrage. So for every $1, you get $1 exposure to aggregate bonds, which is short-term, mid-term, long-term bonds, and $1 of exposure to merger and arbitrage. Let's go ahead and look at the 1-year chart of RSBA. RSBA gave you 8.03%. So a dummy will say, oh, you're so stupid for putting money to RSBA. Only 8.03%. Well, the S&P gave you almost double that. And the NASDAQ gave you almost triple that. Or, yeah, that's what an idiot will tell me. I want you to look at the path of RSBA and pay attention to the drawdowns of the market. And you can see this thing held up like a rock. And I have a question. My purpose of this RSBA is not to give me outperformance of the market, because I'm not comparing beta to beta. This is alpha. This is supposed to give me a performance that is non-correlated to the market, and my objective is it should beat cash. So if you can get like 4% in short-term treasuries or high-yield savings account, I want to get more than 4%. I want to kind of at least try to keep up with inflation. So if you're going to give me 8% and give me rock solid, when the market takes a tumble, I can have this to hold up my portfolio. And people talk about buy the dip, where's your money to buy the dip? Well, this is my dry powder. I can use some of this growth of RSBA, and I can use some of these proceeds to buy the dip and take advantage of the market getting beaten down. Remember, I pretty much have notional exposure 60%, because TQQQ is 20% of this new allocation, but it's 3x leverage, so effectively gives me 60% notional exposure to the NASDAQ, plus CGDV gives me another 10% exposure to the market in a value tilt. So we're up to 70% exposure to the market. And then next we'll talk about RSST, which gives me another 10% exposure to the market. So I effectively have at least 80% notional exposure to the market. RSST is a stacked ETF. For every $1, it gives me $1 of exposure to U.S. large cap equity and $1 exposure to managed futures. Managed futures could save your behind when the market is falling. Managed futures could morph. It could be long bonds. It could be long Bitcoin. It could be long gold. It could be long commodities. So it could morph into anything that is trending in the future spectrum. Now, there's no free lunch, and I look at RSST not really as pure alpha, because remember, it's also beta as well. So it's a mix. It's a hybrid of alpha and beta. So you could see it does have a lot of volatility. It is outperforming the S&P a little bit year over year in total returns, but you definitely could see it's not as stable like a table because it's a stack product. But my hope is, again, hope is not a strategy, but my strategy is that if the market is if equities are down, the portion of RSST which exposes me to large cap equities, of course, will be down. But then the portion that's managed futures, which is, I think it's like a basket of managed futures, that portion may give me some kind of hedge in the market and may protect some of the position. So it can give me, hopefully, if the market is trending down and down, this thing has time to have his managed futures trend in the right direction and kind of give me a little bit of a hedge within it. So it morphs with the market. So again, bottom line, this is a hybrid of alpha and beta all in one. We got two more on the list. We got CDX. 10% went to CDX, which is managed bonds. Same idea. You're going to wonder, why is this only giving you 7.61% total return year over year when the market can give you more than double that, right? Wrong. Because look at the path. This thing, I did have some weird choppiness over here, but overall, this thing is pretty stable as a table. You could see in the past month when the NASDAQ is down 1.35%, S&P is just barely flat, CDX is flat too, not down, but as a hedge for triple leverage NASDAQ, I feel like it did a pretty good job. That's just my opinion. This is not financial advice. Finally, we have a PIMCO product, which is multi-sector bonds. I call it Payload, PYLD. Again, if you look at PIMCO month over month, look at this. It's doing, relatively speaking, pretty well. It's actually up almost 1% month over month. Well, the market was flat and the NASDAQ was down. And if you go to the 1-year chart, you could see, look at this. You're going to be like, oh, it's only 8.72%. Wrong. I'm not looking at this as a beta. I'm looking at this as an alpha. I'm trying to replicate my beta, or the majority of my beta, and bring in as much as alpha as I can to give me diversification, but I also want to beat cash. I think 8.72% could beat what you can get in a high yield savings account or something like that, or treasury products. 8.72%. And look at this. Flat. It's almost as flat as my humor. And you can see here, the S&P, you're going through all that yo-yo and gyrations, the NASDAQ going through all the yo-yo. The S&P and the NASDAQ are pretty correlated. Look at that. So I don't just think this is a better strategy. I backtested and I have the evidence and the numbers to prove it. Let's look at the portfolio visualizer. So I had 2 times the position of blocks, and EGGS and EGGY together were the other half from this chunk of my portfolio that I got rid of. So we're going to call it 50% blocks, 25% EGGY, 25% EGG. So that's this portfolio that I got rid of. We'll call it portfolio number 1 is what I got rid of, and portfolio number 2 is the new evolved portfolio. And as you can see here, portfolio number 2, 20% TQQQ, 20% UGL, 10% CGDV, 10% FLSP, 10% RISPA, 10% RSST or resist, 10% CDX, and 10% payload. And we're going to use this, the NASDAQ as a benchmark because we're going to compare a lot of tech because, a little higher beta than the S&P. And you can see we're only back testing from July till the end of October because a lot of stuff hasn't been out for a long time. It's specifically blocks, I think, came out sometime June, July. So we only have a few months of data. But you could see that if you started with 10K, you get the best, the highest return would have been portfolio number 2, ending up with $12,245 versus portfolio 1 making only $640 versus the NASDAQ, which would have done even better than portfolio 1 with $11,239. So Portfolio number 1 is the loser when it comes to return. Only 6.4% return in July, August, September, October. So 4 months span. Where portfolio number 2 would have given me 22% return in that 4 month span. That is crazy. That is almost 4x the return. Versus the NASDAQ, which would have given me at least twice as much as blocks and EGGS, EGGY. Look at that. Now let's talk about standard deviation. It's not just the return, it's how volatile is it? So you would think that TQQQ, which is triple leverage NASDAQ, is super duper volatile. Yes, I would agree with you if you look at it like an idiot in isolation. But if you look at it as part of a sandwich position, multi-asset, with gold, with systemic premia, with merger arbitrage, with managed futures, with multi-sectored bonds, with all kinds of goodies in there, and you use those goodies as a rebalancing mechanism, the answer would be that the standard deviation is 11.88% in this 4 month span per portfolio visualizer. And this is less than a third of the standard deviation of blocks or EGGY and EGGS, which is 36.94. So I get way less volatility and way better return. Come on. And look at the NASDAQ. The NASDAQ is kind of in the middle, actually less volatile than my portfolio. So the regular NASDAQ is, they're saying in this past 4 months, is less volatile. But considering I have triple leveraged the NASDAQ just to be a couple percent more volatility, I understand. Now, the maximum drawdown, we don't have enough data from 4 months, but my portfolio, my new one that I have, if I had this 4 months ago, would have been 0. The NASDAQ would have been 1.56, and this one with the blocks and the EGGS, EGGY, 14.09% maximum drawdown. That sucks. Sharpe ratio talks about risk-adjusted return. For every unit of risk, are you getting a fair return? Not always is taking more risk equating to more return. So the higher the Sharpe ratio, the sharper you are with your investments and the sharper brain you have. You're making smarter moves in life. Again, that's what people say. So my portfolio is 3.88, Sharpe ratio, which is greater than 1, which is great. The NASDAQ in this period of time is 2.51. But again, this is a very short period of time. This portfolio is 0.45. So again, and most important thing also, one of the important things you don't want to ignore is benchmark correlation. So compared to the NASDAQ, I'm 77% correlated to the NASDAQ versus blocks and EGGY and EGGS is 93% correlated to the NASDAQ. So I have a little bit of a lower correlation to the NASDAQ. And let's look, if you're a picture graph person, look at this graph. Now the green is portfolio number 2. The blue is portfolio number 1, where I came from. And portfolio number 2 is my new portfolio. You could see that there wasn't that sharp drawdown like you see with portfolio number 1 or the mild drawdown just with the NASDAQ. So if you're a grid person, it looks like portfolio number 2 is for the win. Now let's talk about the greater picture of expanding my exposure. So if you go down to the bottom of the screen, you see changes. Before I had 100% of this portfolio in blocks, this piece of the portfolio in blocks, EGGS, EGGY. Before, my exposure was 100% Bitcoin, we'd say Bitcoin miners, crypto and tech, especially AI, high beta tech. Now I have 180% exposure in my expanded portfolio. This is a notional exposure. I have 60% large cap tech, which is the TQQQ, notional exposure, 40% exposure by weight to gold, 10% is large cap value, that's my CGDV, 10% is my large cap blend, which is RSST component of the large cap, 10% managed futures, RSST again, 10% multi-sector bonds, 10% US bonds, aggregated bonds, 10% systemic style premia, 10% merger arbitrage, and 10% hedge bonds. So now I have 180% notional exposure, multi-asset, multi-dimensional, and I'm basically not betting on one type of market cycle. I'm turning my portfolio into an all-weather type of portfolio where I replicate my beta, and now I have space in my portfolio to build in multi-asset, multifaceted all the way around to try. Nobody could predict the future, but all you can do is be smart in the present. And that's what I'm trying to do with my portfolio. I want to be smart in the present. I don't want to have that FOMO, and I don't want to be stupid. So that's what I'm trying to do. I'm trying to create smart beta and smart alpha. Let me know what you guys think about this type of video. This is what I'm doing. This is my journey. Let me know what you guys think about my journey. Be judgmental. No, I'm joking. Don't be too judgmental. But tell me what you think. What kind of, have you thought of something similar like this? Anyways, this is the Working Investor Overnight. I hope you guys have a wonderful trading week. Be well.